Hi, I'm John Baule, and it's time for another Fireside Chat from FutureView. And today I'm here with my colleague Brian McGrath, and we're going to talk about a topic that I think is one of the more interesting finance topics, SaaS metrics. SaaS being a subscription business or a software as a service business. What are the metrics to use for that? And I'll just start off by CEOs that we talk to, they get to a certain point with a SaaS business and they hire their first controller and they get GAAP financial statements. And they realize that for a SaaS business, especially a growing SaaS business, a GAAP financial statement is really not particularly meaningful. Mm-hmm. And so then they say, well, what can I use that will drive my business? And that's where you come up with metrics that show what's the future potential of my business. And we'll elaborate on that a little bit, Brian.
I mean, SaaS businesses are all about investing in portfolios of, assets, customers, revenue streams, whatever, that that produce a return over time, right? Mm-hmm. And so you're buying these portfolios of things that don't show up in your financials for years to come. And mm-hmm. so looking at financial statements, it's one of the reasons I really fell in love or whatever with FP&A as a profession, working in SaaS businesses, because mm-hmm. there's so much emphasis on the underlying metrics and KPIs, if you will, that help inform what happens with the business and the health mm-hmm. of the business in a way that traditional financial statements can't because of the business model. Yeah. And so, the metrics become very important to understanding not only what has happened and what that means about the future, but what you should do next and how to think about planning for your, near to medium to long-term future.
My favorite SaaS metric is probably lifetime value, mm-hmm. Which is a very challenging thing to calculate. In fact, what I found is the more complicated and esoteric the calculation of lifetime value, the less I believe it.
I think one of the things that's fun about LTV is that it's almost like a philosophical debate on the internet about LTV, and you can find kind of ideological positions on LTV, to some degree, and it is a fun metric in that regard. Yeah. But I think the important thing for LTV is that it reflects your business. Mm-hmm. I don't think that you need to lock yourself into, well, this is the way that this blog post said that we had to calculate it. If that doesn't reflect your business, then modify the calculation. What you're trying to get to is an accurate reflection of the value of your customers that helps you make decisions, which is, I think, sometimes where companies can struggle sometimes is that LTV serves two purposes. It helps you tell a story, right, about mm-hmm. the performance and the health of your business, and so there's a motivation there. And as a founder, you want to believe that the value of your relationships is, or as a CEO or executive, right, you want to mm-hmm. believe that the value of your relationships is as high as possible. Right. It helps that helps tell the story about the health of your business as well, right? But you also, I think, need to look at it as an investor, because you have limited resources and mm-hmm. you're trying to deploy those resources to maximize an outcome. And if you take a bit more of a scrupulous look at the value of your customers through your lifetime value mm-hmm. definition, that doesn't mean you're taking a pessimistic look, but you're trying to be as objective as possible with the value of those customers, such that you know where to invest your next dollar. And that particular dichotomy is difficult for companies to manage sometimes. And so it's a balancing act, and you have to choose. You don't have to. You can create multiple lifetime value calculations if you want, but my recommendation is always pick one that strikes a good balance, that's defensible, that is objective, right? Yeah. That gives you as true a picture of the real value that you're willing to put your next dollar against, and run with that. There's no perfect calculation.
So I think this is one of the reasons that SaaS companies struggle, especially ones that are VC backed, because mm-hmm. to me, if someone says there's no absolute good or bad with a lifetime value, right? It is what it is for a business, whether it's $1,000 for a small, tiny little company, or $1 million for a company that sells something more expensive. What's important is that you always calculate it consistently and measure the trend, because that's what you're driving.
Yeah, it's the movement.
Where it gets tricky is now you're an investor as opposed to an operator. When I'm an operator, I want a metric that I can calculate quickly, easily, and regularly in the same manner. If I'm an investor, I want a metric that I can use to demonstrate the value or the lifetime value of my customer base, and I want to compare that to other companies that may do this a completely different way. And so a lot of times you find that the investor is at cross purposes with management. Like, they'll want a measurement that is more complex in some ways, but demonstrates better, because to them a higher number is better than a lower number, where I would say it doesn't matter whether it's low or high. It matters that you're always calculating it exactly the same way.
And that you are investing against that lifetime value in a responsible way.
Yeah,
very
true.
And that
true.
I think is actually the more important metric than just pure lifetime value. It's what do you do with that, right?
Yeah.
If you are going to be, and this is an assessment that companies need to try to objectively make, if you're going to be more aggressive on the way that you calculate lifetime value. I mean, we've seen companies that estimate a 15-year useful life and then don't discount the value of that 15th year back, right? So if you're going to be more aggressive on your lifetime value calculation, you should be more conservative on how much you're willing to invest to get that value, right? Give yourself a little bit of room to potentially be wrong, because on at least on one or two or a handful of customers, you may be wrong, right? And you don't want to be upside down any more than you need to be.
Yeah, unless you're if you're in a technology company and you're investing against a lifetime value that requires 15 years to make sense, you're probably not going to be feeling very good about that.
Well, and that's how metrics can work together too, because these things can often triangulate. So like payback period is another metric that can be a check against your lifetime value. So if you've got a 15-year lifetime value, let's use something more kind of middle of the road. You're saying you've got a 5 to 6 year lifetime value, and your payback period is 3 years. That's very different than if you're telling me that you've got a 4-year lifetime value, but your payback period is 6 months, right?
Yeah.
So
absolutely.
It's the ratio and the comparison of the metrics that help you understand how to assess the value of a business, or the value of the underlying stream of revenues from the customer base.
The lifetime value, like you said, also how much does it cost you to get that lifetime value? That's the second best ratio, right? LTV to CAC. Okay, here's how much it costs me to acquire a customer, and here's the lifetime value I get from that customer. Now, that can also be interesting, because how do you decide what to put into that customer acquisition cost? In theory, almost everything you're doing as a company is designed to acquire customers, right?
Yeah, so if you're a growth-oriented company, then absolutely. I think with CAC, you're going to get a similar answer from me. There's the more aggressive approach to, or more optimistic approach to calculating CAC, and that is, I'm just going to use direct working spend. So, maybe I'm just going to use, if I'm generating revenue from putting dollars to work on Google, I'm just going to take my ad spend on Google, and that's my cost of acquisition. And the people who are running those campaigns, that's overhead, right? That's not part of CAC. You can look at it that way. I don't think there's a right or wrong answer here. I think you have to look at what gives you the most comfort that the dollar of revenue that you get next from that pool of investment is a dollar of profitable good revenue. And if you're only factoring in just the actual working spend and not what it takes to put that spend to work, I think you're potentially missing out on some of the cost of getting that revenue, and therefore you may invest in a place that isn't actually profitable. And so you have to kind of look at CAC as a way of saying, again, objectively, I've taken a look at LTV. I think I understand what an average customer is worth to me, and I need to understand how much I need to spend to get that customer so that I can plan the use of my limited resources as effectively as possible. And if I get that CAC equation wrong, I may inefficiently put money to work because I may overinvest to get revenue that I think is more profitable than it actually is.
I think that's a great point because, and when we talk about this idea of an analytical framework, you're going to define these SaaS metrics that you use. And the reason we have SaaS metrics is because the GAAP financials don't show us everything that we want to see the way we want to see it. However, somewhere those SaaS metrics, if played well, if you deliver the SaaS metrics that you thought were right, it better somehow turn into the right net income at the end of the day, or the and you got to put all those together. So if you have a bunch of metrics that never associate with revenue or net income, you could definitely fool yourself.
Yeah. I mean, you kind of see this sometimes where there's a story from the metric standpoint that sounds great. Bookings are going up. ARR is growing. All LTV to CAC is 5 to 1, right? And then you look. And it's been that way for years, right? And you look at revenue growth and it's 10%, 15%. It's like, well, if bookings are growing 50% and LTV to CAC is 5 to 1, and how is it that revenue is only growing 10% and net income you're losing money, right?
You're missing something in the framework chain, in the framework.
And that doesn't mean that you have an unhealthy business. It just means that the metrics that you're using to drive that business may not be optimized from a methodology standpoint to help you make the best decisions possible, because 10 or 15% may be pretty good for whatever business you're in terms of revenue growth, but the story of the inputs and the investment and the return that you should be getting from that don't match up with the actual results, which means that you might be able to actually improve those results with a better metric framework.
Totally makes sense, and we've seen that before where, we both know one company where I think when we first looked at the metrics and the way they were calculating lifetime value to CAC, I mean, they were investing to beat the band because you couldn't invest enough, but it turned out that with every customer they were acquiring, they were losing money.
Right,
So you don't want to have that kind of situation, and you've got to almost be able to model these metrics out to the ultimate. At the end, you still have a scoreboard that includes traditional GAAP measurements that you have to get to.
Yeah, and that really ties this all together. A good analytical framework and metric framework should be something that you can use to plan the performance of your business, right? So if you tell me that bookings are going up 50%, and it's a good bookings calculation, it's a good metric, that bookings number should be a projection of future growth. Right? So if you tell me bookings are going up 50% and revenue is not reflecting that growth in the following 12 to 18 months, I can't rely on that as an input to my planning framework, or if I rely on it, I'm by default going to have a variance that's difficult to explain. And so I'm setting myself up to have a difficult conversation down the road by not tying those metrics together with the true performance of the business. Right? And I don't think people do. I think this is just. I think when we see this, it's not potentially not fully understanding the link between the methodology of the metrics and the performance of the financials in a way that would help optimize that. And we, by tying these things together in a more cohesive way, you can actually, it pays a lot of dividends in helping to tell the story 6 to 12 months from now.
Yeah, if I operate on all my metrics, it's kind of like a football game. If I generate this many passing yards and this many running yards and this many, it better somehow translate into a score. One of the most frustrating things is when your team does really well and it doesn't turn into a score. What that tells you is you're missing something in the framework that doesn't turn into a win. Yeah,
if you've got a wide receiver who's got more yards than any other wide receiver, but you've lost every game and your lowest points per game, it's like,
what am I missing? What am I not calculating?
There's something missing there, right?
It's a kind of an interesting thing, because you see like maybe that's why then you start to look at things like success in the red zone and success and how many teams never quite make it to that.
Yeah.
Interesting. The one other thing I wanted to touch on was I'd be curious your opinion, but to me, a metric is only good if not only can you calculate that metric, and I would say you have to be able to calculate it regularly and efficiently. Otherwise, if it's too hard to calculate, if your metric requires an act of God from the finance group to get it together each time, it's never going to be a regular operating metric that you have to have, right?
I mean, said another way, if it's important, if you hone your metrics down, particularly in a SaaS business, to the things that help you drive decisions, you should be willing to invest in making sure that you can see those metrics in whatever cadence, on whatever cadence is necessary to make the decisions.
Yeah.
And if that requires a Herculean effort to get that data turned around to you, you probably haven't invested enough in those metrics and being able to produce them from your framework, from your infrastructure.
We've seen that a lot with companies that get investments from, say, PE firms, where the PE firm wants to track a metric against a model that they developed, but the reality is to get to that metric is one of the hardest. You can't calculate it regularly. You can't make sense of it. So yeah, I agree. It's got to be easy to calculate and put together. So
which means you may need to look at your whole data infrastructure and how you're tracking information in your organization. What are the systems of record? How do you get the inputs into that metric in a way that is efficient and repeatable and scalable?
One of the interesting things is like public companies. They have, you're kind of required by the SEC to define some of your key metrics, or at the same time that you obviously show the GAAP financials, and it's kind of comical sometimes because you read the metrics that the companies come up with, and they tell you absolutely nothing about how you got to the financials. You know, like churn is always my favorite. Like churn, how many SaaS companies show churn above 100%? Always. What do you do with that? And we don't report it above 100%. So. But it doesn't tell you much about how to think about the business in the future. And I think that's the key with these SaaS metrics, is they're very much future oriented. I mean, SaaS, like you said, it's a business that's about growth. A SaaS business is about acquiring the future growth now. Interesting.
Yeah, if you really want to understand the health of a SaaS business, you've got to have a good metric framework, and you've got to have consistency and measurement of it on a regular cadence, so that you can understand, which dials to turn in order to maximize your outcome. Churn is really that one that churn is like the Achilles heel of so many SaaS companies, because they can look really good for a while. Yeah. Because you're acquiring greenfield opportunity, and maybe you got some new technology, and you're pulling in all these new customers, and then all of a sudden you run out of greenfield opportunity, but your other customers are leaving you at a higher rate than you told, and all of a sudden that growth rate just tails off. And it's also very difficult to look at, as an owner of a business, I can attest to it. It's difficult to look at your business and think about having a high churn rate, right? Or to see your churn rate, or your retention rate decreasing, or your churn rate increasing. That's a difficult thing to digest, and there are enough ways to change a churn calculation to compensate for one-off things that oftentimes you see companies start to experience some increased churn for whatever reason, and legitimately sometimes there are some one-time things that don't really impact the metric in a way that reflects the true health of the business. But I think trying to get to, again, as objective a measure of the true churn of the business as possible, and keeping it a consistent measurement, is important, because if you have a churn problem, you want to know as soon as humanly possible, because again, what decisions are you going to make off of that metric? Like if your churn is increasing, it's something, there might be something there that you need to be doing different. Yeah, I'm doing something wrong with my customer relation. And that's the one other thing I think is really interesting with a SaaS business. SaaS is kind of, we always associate it with like a technology type business, but really when I think of, and a lot of companies we see trying to convert themselves, they try to think of themselves as a SaaS business, but it's really about
the length of relationship. Like I've seen metrics where Starbucks will create a lifetime value. Now you wouldn't necessarily think of Starbucks as a SaaS business per se, but the fact is that they build your loyalty. They get that, and then they sell you, coffee for the remainder of your life. If you're my kids, they spend a fortune at Starbucks. So I think you could almost look at almost any. I actually thought about that with. I used to be at. Mead Johnson in the infant formula business, and you think, wow, how many orders am I going to get this time? But really, it's a pure SaaS business. There's this many babies being born, and I got this share, and these are the things that I measure. So the whole SaaS framework really works beyond just what we traditionally think of as SaaS businesses.
Yeah, I mean, SaaS is just the recurring revenue model applied to software businesses, right?
Yeah.
But if you take, I think because of the dollars involved in SaaS, they're often bigger, big dollar volume deals, lots of, big businesses, things like that, and you're investing a lot of money in it. I think that business model, SaaS in particular, has further informed the way to think about the, just generally speaking, recurring revenue model and the value of having a committed stream of revenue and the rigor of knowing how to invest against that revenue stream, and that furthering of the knowledge base around that type of recurring revenue stream, whether it's software or service or CPG or whatever, is applicable everywhere, right? To your point, if you think about every baby as a unit of value, right, to Mead Johnson, they're going to consume X number of, ounces of formula over their life. And so you can think about that as just a recurring stream of revenue based on how many babies use Mead Johnson, right? Baby formula.
It's very interesting. The modeling piece is a lot of things you can do with it.
The cost of acquiring babies is the conversation starts to get
we go into
to
all
get
different
uphill there, but
generating demand is a different Anyway, well, listen, this is a good discussion. I think there's a lot more we could go into with on this topic. It's one that has a lot of depth to it, but I appreciate the time, and thank you very much. This has been another episode of FutureView Fireside Chat.
If you're looking to rapidly transform your finance function, visit us at FutureViewSystems.com.